Markets under pressure. We've got these stubborn inflationary pressures in the United States, creating pessimism about rate cuts. Maybe there won't be reductions till December after the election. Our guest says high inflation is good for commodities, and he has some ideas for us. Sam Labell joins us now, portfolio manager with Veritas Asset Management. It's great to see you.
Thanks for having me.
So if we can't beat inflation, learn to love it, and you think commodities are a decent play right now?
Commodities are a decent play, provided the economic picture holds up, even though we saw today GDP coming down to 1.6% growth year over year, which is a very soft number for the U.S. That's not necessarily in stall mode. You're still seeing employment growth in the U.S.
Okay.
1.9% year over year in March for non-farm payrolls. You're seeing wage growth in the U.S. So there's still this underlying pressure. Wages are going up. Inflation's staying high. There's a number of reasons for that. Kind of confusing that there are two measures of GDP. Another one comes out tomorrow with another measure, and they give two different numbers. But today's early read is likely to be echoed tomorrow, so we'll see what that looks like. And ultimately, that's something that's to be expected. The last time we were on, we talked about how there's a big fiscal deficit in the U.S. Since 1947, there's only been 9 years where they've run 5% of GDP deficits. And 4 of those years have come from 2020 on.
So it's only been 4 years where they ran surpluses.
Deficits. So they're spending more than they're taking in the U.S. And there's a deficit spending picture in the federal government in the U.S. of last year 7.5% of GDP whole, and we think it'll be over 5% again this year. And so you have kind of this conflicting monetary and fiscal policy. Monetary policy is extremely tight. If you look at the Fed overnight rate and take off inflation expectations, about 3.5%. We've had recessions start at 2% real rates. So it's really quite tight. So it's not a surprise that a lot of these economic measures are decelerating. Employment growth is decelerating. GDP is decelerating. And ultimately, we think that the fiscal side of it being so stimulative is keeping it kind of in play. Now, you are borrowing from the future for that. And it does put inflationary pressures on the economy, which is several reasons, in classical economics, why inflation would hold up. Wage growth, deficit spending at the government, all of these reasons do kind of add up to a longer-term inflation picture.
So you do like energy, but a lot of familiar names, Cenovus, well, kind of oil sands focused, Canadian Natural, and then Suncor, and then on the gas side, Tourmaline and ARC.
Yes, so ultimately we think that we're entering a nice stable period for oil. OPEC has signaled that they're willing to reduce production. The main production growth is coming out of North America, but the costs on that production, especially the Permian Basin, are going up. So you're looking at a break-even cost in the low 60s now, U.S. So that kind of puts a floor on where oil could go, because that is the marginal supply. The biggest thing you're always worried about with oil is that there's a greater economic slowdown globally. 1 million barrels per day, too much oil is a disaster and prices crash. But right now we're looking at a picture where we're actually slightly undersupplied. Demand growth is fairly weak in the OECD, but it is growing outside of the OECD. So the International Energy Agency, their forecast has us 300,000 barrels a day short this year. That helps bring down some of the inventories, and we're still seeing some growth out of the U.S. So that all spells a stable price for the oil market. And ultimately, with oil sands, you have a lot of sunk costs. You have very low decline rates because you've got these huge 25, 30-year mines. And so that stability generates a lot of cash flow, high free cash flow yields in the teens. Most of those companies have hit their debt target or gotten beyond it, and so they can return that cash flow to shareholders.
Which they are in many cases, Yes. Your team is not convinced that copper's going higher from here.
Well, copper is right now a bit of a story stock in that EV demand, additional data center capacity for artificial intelligence. All this is expected to spur a ton of need for copper to build out our electricity production. And so that's a longer-term story, yet copper has gone up in the short term. And I think I was mentioning that Dr. Copper did not get the message here. Dr. Copper is the name given to copper because it usually forecasts what the economy is going to do. Well, copper has rallied 16% this year. This goes beyond the economic slowdown that we're seeing in the U.S. And it really comes back to a shortage of supply and underinvestment in copper. The big story of last year was the cancellation of the Cobra Cobre Panama mine, and that was supposed to bring on a big supply of copper. So now people have kind of re-rated all the existing mines that have permits. They're more valuable. Copper is more valuable because we're not expecting that same supply growth in the near term. And that's allowed people to come in and speculate a little bit and drive up the price.
On the telecom side, we're very tight for time.
Yeah.
Rogers would be your favorite. BCE too soon? You're not interested in BCE right now.
So what's happened in telecom is that you've had one player consolidate another with a lot of debt. And when that happens in a lot of cases with an oligopoly type of industry, competition picks up because the heavily indebted party will be a lot more aggressive on getting subscribers. And that's kind of what we're seeing in the telecom space. The overall growth of the market has slowed. And so they're much more aggressive in trying to keep their customers and gain customers. Rogers has been the best at adding customers. They had 98,000 additions in the most recent quarter. And so that's why we like them. They're running at about a 12% free cash flow yield. And we've done some work taking a look at what the payout ratio might be at BCE when you take into account all the leases and all the other things that are going on. And we think that their free cash yield is somewhere down at 7%. So it's not as attractive. Similar story of TELUS, about an 8.5% free cash flow yield. So even though that free cash is going to pay down debt in Rogers' case, that's their plan. They're going to sell some assets as well. That pay down of debt technically goes to equity holders. And so we think that the longer term story here is that Rogers will re-rate upwards and it's still growing its earnings. So that's why we like them.